Welcome to Digit Money and thanks for joining us on this episode. Technical indicators makes it simple to spot current market patterns and forecast future price movements. For the course of this video, and to avoid being trapped by most trading fallacies, you need to understand that technical indicators can be classified into three groups. And this is because many a time, traders use indicators that show the same type of information and end up getting false market predictions or missing out on good trades. Let's try exploring these indicators. First, the trend following indicator, moving averages, parabolic stop and resistance, and Bollinger Bands are a few of the trend following indicators. In this video, we are going to look at Bollinger Bands because it combines a range of moving averages to convey the well-meaning of the market position. Bollinger Bands are a widely used indicator that can be used to identify market reversals. Bollinger Bands are formed by three clear lines. The indicator's main line is a 20-period simple moving average by default. The bands are also set to 20, by default in two settings. The upper line is calculated by adding two standard deviations to the main line moving average. This creates an upper boundary for the price. And the lower line is calculated by subtracting two standard deviations from the main line moving average as well. This creates a lower price limit. The general principle for Bollinger Bands is that 90% of price action occurs within these bands. When the price moves above the upper band, we expect the price to find resistance and reverse downwards. Similarly, when the price moves below the lower band, we expect the price to find support and move upwards. So we always use the Bollinger Bands to spot reversal opportunities. For example, let's set the Bollinger Band on a 100-period moving average with two standard deviations above and below the main line. When the price is trading above the upper band, it means the price is stretched upwards, and we can expect a down move. So we'll look for selling opportunities. On the other way, when the price is trading below the lower band, it means the price is stretched downwards, and we will look for buying opportunities. It is important to remember that before we enter a trade, we will need some form of confirmation, which we will get by looking out for divergences in the momentum indicator. And that will lead us to the second group of indicators, which will be from momentum indicator. MACD, Stochastic Oscillator, and Relative Strength Index, the RSI, are indicators in this class, and for accurate divergence, we will study the RSI indicator. The relative strength value is plotted on a graph with a scale of 0 to 100. Plotting this line helps investors measure momentum in relative terms, which means looking at the indicator's current value in relation to past values. To identify potential trend changes, we have two ranges of the indicator. The overbought, here at 70, and oversold at 30. Overbought refers to an asset that has increased rapidly in a short period of time and may reverse back. Conversely, oversold refers to an asset that has decreased sharply in a short period of time and may reverse to upside direction. Now that you know how the RSI measures momentum, let's look at how investors might use this indicator to identify potential trading signals using a trend reversal. A trend reversal that creates trading signals may be confirmed by the RSI when it shows a divergence. A divergence occurs when an asset's price moves one way, and RSI moves in the opposite direction. For example, a bullish divergence occurs when an asset makes lower lows, but RSI makes higher lows. This can be a signal that downward momentum is showing some weakness and a bullish reversal may follow. After identifying a bullish divergence, an investor might use a cross back above 30 as an entry signal. Going the other way, a bearish divergence occurs when an asset shows higher highs, but RSI shows lower highs. This can be a sign that upward momentum is slowing down and a bearish reversal may occur. After spotting a bearish divergence, an investor might use a cross back below 70 as an exit signal. Using the RSI to spot divergences and identify potential oversold and overbought conditions can help investors find potential trading signals. However, this doesn't mean using RSI is a foolproof. One of the main risks of using RSI is that its signals are not always accurate. The RSI is frequently used in conjunction with other types of confirmation, such as volume indicators, and the overall market trend. Even though the RSI indicator is imperfect, traders who use it in their trading may find the insights it gives valuable. Finally, the volume indicators, the third group of indicators. Traders can use volume indicators to identify the strong relationship between price action and volume. Increases in trading volume almost always result in an increase in price. However, these events do not always occur at the same time, which is why volume indicators are good for advanced forecasting. 3 of the most useful volume indicators are on balance volume, the OBV, money flow index, and accumulation or distribution. In this video, we will look at the on balance volume indicator, the OBV. The OBV indicator measures the difference between price action and the actual volume of an asset and market participants. When the price action goes up, the OBV usually follows the market direction. Going the other way, when price action goes down, the OBV typically goes down too. But this indicator comes into its importance when there are divergences between the two. Let's look at some examples. I would like to use the most recent available price action. As we can see here, if we draw lines across the price action and the OBV indicator, they are both rising. These tells us that this is a reasonable uptrend based on reasonable volume. But look at what happens next. The price action continues in an uptrend, but OBV is now going downwards. And what this tells us is that the uptrend is based on very low upwards volume. We effectively have a divergence between the two now. This is one of the key signals that the OBV indicator provides. That tells us that this trend is weakening significantly, and we are about to experience either a reversal or the emergence of a trading range. And by revealing the next part of the price action, we can see that's exactly what occurs. I hope you enjoyed this video. If you found this video helpful, do let me know by giving this video a thumbs up and commenting below. Subscribe and ring the bell to get notified whenever we upload a new video. Thanks for watching.